Did you know that there are loans that you can assume or take over from the original owner? It's called an assumable loan, and this video is going to cover the basics of what you need to know and how to find them. I'm Jennifer, a mortgage loan officer for almost 3 decades, and on my channel, I'm super passionate about real facts, no BS, everything about mortgage so you can make the best decision on your next home loan. So the first thing to know about assumable loans is that not all of them are assumable. So this is really, really important. Only the government loans are assumable. So what does that mean? Government loans, there's 3 types of government loans. There's FHA, Federal Housing Administration. There's USDA, which is United States Department of Agriculture. That's for more rural outside of the city properties. And then there's VA. Those are loans to help our military veterans. So those are the 3 types of government loans, and all of them are assumable. But there are some restrictions, and that's what you're going to learn in this video. So the main benefits of assumable loans are when the seller is going to sell. A lot of the benefits are for the seller because the seller is going to sell their house faster. The benefit to the buyer is that they're going to get most likely an interest rate that is lower than what the current market is. Now, at the time that I'm making this video, it's 2022. Rates are really high. So rates are 6-7%. Now, those people, those sellers that are selling their homes and they got a 2 or a 3% interest rate several years ago, and they have a government loan, they're able to potentially offer this to a potential buyer, and you can get in for a really, really low price. So here are the requirements that you need to be aware of. The first most important thing to know is that there might be a difference between the loan that the seller has and the price that you're paying for the house. So let's say that the seller's loan is $200,000, and that's the loan that's in existence, and that the new price is $300,000. So that's a $100,000 gap that has to be paid. Now, you as the buyer can either come up with the money on your own, or you can get a secondary loan to help bridge the difference minus whatever your down payment is. So it's really important to check with the lender of the seller. So the seller will give you the lender information, and you'll have to contact that lender in order to find out what the requirements are. The other thing to be aware of is that you must qualify for the home loan as well. So the lender's going to pull your credit, they're going to get documents just like they would on any other loan, and you'll need to qualify under the requirements of that loan. So it's not mandatory that it's going to be approved. So that's really important to note, is that you have to qualify. So on assumable loans, again, remember that we're talking about what is an assumable loan. There's 3 types of loans that are assumable. There's FHA, VA, and there's USDA. So on a VA loan, which is for our veterans, our retired military, there's a couple of things to note on those loans that aren't applicable to some of the others. So on a veteran loan, that veteran qualified at the time of purchase, and they had to show that they had military benefits and that they were eligible for a veteran's loan. So the new buyer that's assuming the loan does not have to be in the military. So that's good news. They can be a civilian. However, that seller needs to know that if that civilian is buying their home, it might be holding the military benefits with it. So the seller will not be able to take their military veteran benefits possibly to the new home that they're purchasing. So it's really important to check that out quickly if the buyer of the home that's being assumed is not a veteran. So what's the process to assume a loan? So again, we're talking about what is an assumable loan. It's important to get the information for the current lender. The seller's going to have that information. The seller will have to give permission for you to talk to the lender about the loan. They'll connect you with the lender of record, and you'll start to ask questions about assumability, what are the requirements, what's the current rate, etc., etc. Now, it's also important to note that the process might take a little bit longer because there's a lot of back and forth. So it might not be as streamlined as getting a new loan. So the main benefit of an assumable loan is that you're assuming the terms of the loan that's in existence. So usually this is only a benefit when the rates are a lot lower than the current market rates that are in existence. So thanks for sticking around the channel. Be sure to check out some of the other videos that we have at the end. We look forward to educating you soon.